But let me also welcome on board then Vibha Padalkar and talk about how their quarterly numbers were. Vibha, great to have you on the show. Vibha, of course, is the MD and CEO at HDFC Life Insurance. Vibha, we've seen a strong growth when it comes to APE of about almost 30% on a year-on-year basis. However, profits for you have declined quite sharply in the first quarter. And this being a quarter of peak second wave as well. Share with us the impact that you felt of the second wave on your business during the quarter gone by.
Absolutely. And this is something that we've been talking about as well, because insurers can't be any different from what India Inc. has been witnessing. And the second wave of COVID has been significantly steeper in terms of the number of death claims and the number of deaths than wave one. And wave one itself was more elevated in terms of claims versus pre-COVID. And as a result of which, if you recall, 2 years ago, right at the start of wave one, we had a additional excess mortality reserve of 41 crores, which we then increased it 4 times to 165 crores. That 165 crores was sufficient for what we have seen as claims in quarter one. In fact, 69 crores is still left over unutilized from that starting point. However, we felt that just looking at the pattern of claims and the elevated levels of claims that we are receiving, and then triangulating that with the deaths that have happened in India, especially in the month of May, we do believe that claims will continue to be elevated significantly for at least the next 3 or 4 months. More likely 3 months, lesser likely 4 months, but somewhere in that range. And hence we thought that it is prudent for us to set up a reserve of 700 crores. And the decline that you see in profit is exactly because of this reason. Had that not been the case, of course, it would have been a very different outcome. But we do believe that it's prudent, and we will continue to review it and whether we have utilized the 700 crores at the end of every quarter.
Sure. Vibha, you did mention that you did see claims to rise in about 3 to 4 months, and the management had set aside about 700 odd crore rupees as reserves. Given the risk of COVID third wave and the rise in claims ahead, perhaps, do you see the need for setting aside a larger sum?
No, we do believe that as the visibility that we have today, 700 crores actually errs on the side of caution. We do believe that this will cover and will be enough to cover both individual as well as group claims. The only exception being that this does not factor in whether there's going to be a wave 3 or not. But as far as wave 2 and the deaths that have happened, this should be more than sufficient to pay off the claims over and above the normal reserving in terms of the claims payout.
So what to your mind has been the big difference in the customer behavior? I mean, pre-COVID and post-COVID, has anything changed in terms of the approach of an insurance buyer?
In the first wave, if you recall, there was quite a surge in demand, especially for protection, quite rightly. And that is something that we have seen in other parts of the world as well at the start of any pandemic, even earlier with SARS and MERS and so on. And that's exactly what we saw. If you were to look at the Google searches, HDFC Life and also term insurance continues to remain elevated versus pre-COVID levels. So in terms of just the demand being there, that continues to be robust. Yes, it was exceptionally robust in quarter one of last year versus this year. This year, we're also facing more of a supply side demand. And by that, I mean, we need people to perhaps get more medical tests done. We need them to give more KYC and financial documentation before we can issue them with a term policy. So some of that is happening. So to give you a sense, today out of every 100 customers, maybe we issue or we are able to issue policies for about 60, maybe 62. And rest we'll have to either decline or postpone or defer and so on from just from the fact that a lot of our risk management and underwriting we're not able to satisfy just given various stages of lockdown. But I'm a believer that the story of protection is intact. Yes, there are some supply side constraints, like I mentioned. There's also some level of caution that is exhibited by reinsurers. And ultimately, a large chunk of our books are reinsured, and we can play within the four corners of how much we are able to reinsure. So all of that, I think, is going through a lot of volatility on various metrics, and hopefully if the third wave happens and is milder, that should help us tide through. And so I go back to my earlier statement that fundamentally we are on the right track in terms of emphasizing on protection, and that it will continue to remain very, very relevant, as the concept of human life value protection is even more obvious today than it might have been before the pandemic.
Vibha, you did mention that in the second wave, the claims are 3 to 4 times higher than the first wave. Now, are there any parallels in the past which can, in a sense, substantiate that this is a one-off? How do you see things then, normalizing?
The only other pandemic, I think, because when you talk about the Spanish flu, that is, just way back in time, century ago. So I think the more relevant ones would be more recent SARS, for example. But even there, the level of mortality perhaps was not what India witnessed in the months of second half of April and whole of May. So really, there are no direct comparables to in recent times to the question that you're asking. And that's why it did catch everyone unprepared. And the whole country was just figuring out way to come out of this reasonably intact, and insurers too were on the receiving end of of the kind of elevated claims that we are seeing, and also significantly more elevated than the 4 times reserve that we set up at the start of this year. Even that was not sufficient going forward in Q2 and Q3, sufficient to take care of Q1. But down the line, given how severe it has been, I don't think anyone could have foreseen it.
Okay. Vibha, given your strong performance in AP with a growth of about 30% year on year and 40% growth on the VNB front, what led to the strong performance here?
The good aspect was that there was a lot of learnings from the first wave of the pandemic. And so transacting digital from our employees being comfortable transacting to prospective customers, to our intermediaries, partners. So it became a non-issue for us to reach out to prospective customers. So that was very important. Second is that customers were willing to buy a lot of savings-led protection. If they were not able to get term protection for the reasons that we just talked about, they were okay to explore at least getting some level of cover. So savings-led protection did very well. Our non-par savings as well as participating savings grew very well. And also our channels, especially our proprietary channels, grew over 45% and came back with a bang. And last year, first quarter, proprietary channels struggled a little bit because those channels typically have been face-to-face, in-person, fairly close level of connect with the prospective customer. They too have transitioned to using entirely digital or semi-digital modes of getting to the customer or getting to the partner. And so that is the kind of transition that we are beginning to see, and that has led to a very robust growth. And also the fact that we do have leading products in almost every segment meant that we started becoming insurer of choice. And the pull, despite the pandemic, the pull for our products continued to be robust, ending in a 30% APE growth.
Sure. Also, growth in embedded value, Vibha, has been strong at 21% on a year-on-year basis. Walk us through the internals during this quarter.
Absolutely. So few elements here. If you were to look at the new business margin itself, which is the accretion to embedded value, that was a very robust 26.2% for the quarter. and these are at actual costs. And this is even higher than where we ended last year on a full year basis of 26.1%. It was significantly higher than the 24.3% new business margin of Q1 of last year. As a result of which, the operating return of embedded value was again very robust of 16.7% versus a previous year number of 15.8%. This is, of course, before the 700 crores impact that I've talked about in terms of reserving. And hence the value of new business growth was 40% and very, very robust in terms of addition to embedded value. And hence we ended our embedded value at 27,331 crores, which YOY, so that versus last year was a very healthy 21% growth YOY. And we ended at a solvency of 203%. So all in all, if you were to, apart from the 700 crores that we talked about in terms of strengthening our reserves for excess mortality claims, otherwise, whether it's top line or bottom line, it has been a very good quarter.
Right. Also, your solvency ratio, Vibha, has been fairly strong at a solid 203%. However, given the risk of the third wave and given that higher claims were made during the quarter gone by already, would there be a need to raise perhaps further capital during this year?
So as of now, we don't see that as being a necessity. We did raise 600 crores last year as sub-debt. And given that our solvency continues to remain healthy, about 200%, we don't see the need, but we will continue to monitor the situation very closely. And of course, if there is a requirement, we will have to do the needful. But right now, even when we stress test our solvency with various scenarios in terms of whether it's mortality, adverse mortality experience, or adverse interest rate experience, and so on, we don't see the need for raising capital in the immediate short term.
Sure. In your earlier conversation with us, Vibha, you've stated that the management is looking at a balanced product mix and that we're seeing healthy growth in the annuity business as well. How do you see the product mix shape up going forward?
So we remain very, very focused as well as enthused about the prospects of both protection in terms of mortality protection as well as longevity protection, which means that the entire retirement spectrum and people both saving as well as buying annuities. So both aspects of it is something that we've always talked about. And it's as part of that opportunity that we have been focused on, and that's what has seen the kind of annuity growth of 61%. And this growth has come both from selling annuity to our own customers whose policies are maturing, as well as to new customers who could be part of retiring PSUs, other large corporates, and so on, or even in the open market. We also have a pension subsidiary which is under the NPS, and that the subsidiary, the 100% subsidiary, has crossed 18,000 crores as assets under management and has about a 35% market share. So all of that means that one needs to look at how the retirement corpus and how the opportunity of tapping retirement, and we need to go about it in a holistic manner, which is really what you're seeing right now. So this is a culmination of the strategy that we articulated in our. You would have found that in our investor presentation even a couple of years back. So that's as far as retirement product, and you'll see that inching up from being maybe 5% of our business to hopefully over the next few years it becoming 10% of our business. Similarly, in terms of protection, while individual protection today is a little bit muted, but when you look at it along with Credit Protect, very certainly the growth has been extremely robust in terms of overall protection. So these are some of the pockets that, apart from selling savings-led insurance products, we will continue to focus on these very distinct opportunities wherein we have to innovate, we have to have new products, we have to have a go-to-market strategy, and all of that culminates into the kind of growth numbers that you're beginning to see.
Right. I have a two-part question for you next, Vibha. Given the circumstances that we are in, do you think that there is bound to be consolidation in the industry, and do you see more FDI coming in? And B, if that were to be the case, what kind of M&A opportunities would interest you at HDFC Life?
FDI relaxation that has come through is very welcome. Just from a overall signaling point of view, to say, Indian life insurance sector is now open to business. Come invest in India. And it's in a way, it is the maturing of that sector. And so from a directional perspective, it is extremely welcome. And we are very thankful for having been granted that by our government. Now, having said that, today we're hovering between life and general insurance around 33-35%. So it hasn't been maxed out to 49% even today. Hopefully, over the next few years, we will start seeing money flows coming in, and that should see the development of the sector even further, especially the smaller players who possibly might be strapped of capital, might be wanting more capital, and the domestic promoter is perhaps unwilling or unable to infuse capital, and that's when this opening up can certainly help. But it will take some time, I think, because the economics, the overall conducive environment, the relaxation of some of the policies will mean that all of that will have to come together for it to be an attractive destination for foreign capital. On your second point about M&A, it's no secret that HDFC Life does have a very, very strong balance sheet. We have the currency and we have the appetite. So we will continue to evaluate new opportunities. We continue to be enthused by some of the opportunities that keep time and again coming up. And we will evaluate it to see that whether there is a niche offering that can be attractive to us at a valuation that is palatable. And we will continue to scout around and do the needful. Up to now, unfortunately, there's never been a single full-fledged M&A in the Indian life insurance sector. But who knows, if we're the first ones to, then that will be a great place for us.
Okay, Vibha, great to have you on the show, and thanks for joining in as always. Good speaking with you.